Lead that in God's hand. And watch what God does.
All right. All right, you guys can all hear me. We've got the recording going. Okay, we'll get this started. Well, thank you so much, and welcome to How to Get Your First Multifamily Investment Deal. My name is Annabelle Pacheco. Just a quick introduction. I am an investor. I'm a real estate broker. I've been in business for 24 years and part of a global real estate company, eXp Realty. And really my goal doing this weekly call is to share with each one of you the steps that I took in purchasing my first multifamily deal, also bringing guest speakers from the multifamily space to share with us and really just expand on our knowledge and learn what other people are doing out there so that we can all, I mean, including myself, but we can all go out there and do this. I encourage everyone to participate, ask questions. If you're currently, thinking of getting involved in multifamily, or you are, and certain things are occurring, this is a great platform. Ask questions, share maybe some wins as well that could help others on this call, and just really it's so that we can all learn from each other. I want everyone to know on this call that I am not selling anything. I'm not offering anything. I am not a financial advisor. I'm just sharing my story and hope that you guys can all learn from this. Just a little bit about myself. I started in the mortgage industry back in the early 90s and purchased really during that time while I was doing loans. The market was great. And I ended up purchasing probably over 100 properties throughout my career. We were renovating and flipping a lot of properties at that time, and had 2 to 4 units that we were keeping and just renting out and managing. So we did that for some time, and then market shifted a bit. And in 2001, we kind of deviated a bit and we built a 150 capacity restaurant from ground up. We had full staff. Probably we had over 15 people, including managers, chefs, and servers. And we did that for about 8 years and was very, very happy when I was able to hand over the key, because talk about a hard and sacrificed business, and definitely the restaurant business is one of those. I mean, you're working holidays, you're working every day. And it's not as rewarding as real estate can be, at least for me. But anyway, that is past, and the last 10, 11 years of my business have been focused in representing clients in the residential and commercial real estate, including some multifamily as well. So I purchased my first multifamily property, which was 34 doors in Texas in 2015. And really by 2015, I was done with just fixing, like rehabbing and flipping. I mean, it was great, and we did very well, but it's just you're constantly you're going out to find a property, you're fixing it, you're flipping it, now you've got to go out and find more properties. And we were just looking for a way to create cash flow and generational wealth. And I will say that for us, multifamily was the way to do it. And so I'll just kind of give you guys a little bit of why, we decided, like, we were looking just for a way to make our money work for us. And here are the reasons why I invested in multifamily property. So number one, we were looking for cash flow, right? Very simple. Rental income minus all of your expenses is your cash flow. What is this property going to produce for us on a monthly basis? And then number two, it was, what a great opportunity that your loan is actually being paid off by your tenants, right? You don't feel it. It's just the cash flows coming in, the loan is being paid off, and then the difference minus your expenses is yours. Number three, it was appreciation. And this is where You know, this was the key for us. In 2015, we thought we were actually overpaying for our property. And little did we know that we got such a great deal, right? But you have to find, you kind of find out down the road, you can speculate. But really back then when I decided to go into multifamily, I was really just kind of looking for cash flow, and I knew appreciation would come, right, over the long period of holding that property. But I definitely didn't think it would be as great as it was for me on this deal. And then number 4, it was the tax benefits. For me, it was really to, like, number 1 was depreciation. I'd be able to expense a portion of that physical structure each year. And then really the opportunity of having to, being able to do a 1031 exchange, which allows you to defer capital gain taxes, no limit, right? So if you find great opportunities out there, and you know that you can sell your property to either, you know, improve cash flow, it's just a great opportunity. I mean, it's not easy, but it's out there and available for everyone. So let me give you guys a little example of kind of what happened to me. So in 2015, we were looking, now you gotta, you know, go back and think that I've been involved in rehabbing and flipping single family residences and 2 to 4 units. And we had that same mentality when we were out looking for multifamily. So we were looking for that multifamily property that needed work. That we knew we weren't going to flip, but we knew that if we fixed up, we could increase the rent, right? And that's where the money's at. So value add just really means that you're buying a property that's maybe not in the best, but it's not the worst area. You can improve the condition of the property by renovating it, and then you improve the net operating income by increasing the rents, right? So what we did is we purchased this property for $850,000 in 2015. And when I called, I actually happened to find this property on LoopNet, and I called, and the agent happened to be the owner. And I, the buyer, was an agent myself. So just really, it was meant to be. We had a conversation. I was interested. We met, we took a look at the property, and we began negotiating. And he was willing to, I asked if he'd be interested in seller financing, and he agreed. So we really gave him $350 down. We had about, I want to say, probably about $500,000, and maybe a little more, but 350 is what we were able to, you know, negotiate with him. And then he carried a note for 2 years for the remaining balance of $500,000. What this allowed us is that, I mean, it was gonna be tough to go out and get a loan on a property that really wasn't producing. So I think that it was a combination of 2 things. He knew that, and he knew, okay, he wanted to unload this property, and he was probably making more money from being our lender than he was cash flowing from this property. So it made financial sense for him, and it worked for us because it really made our life very easy. We didn't have to go through this qualifying and just through the lender, to the lender part. So we had 2 years to go in there and remodel and improve.
When he got to a certain point in the paint.
Can someone mute? Here. Wait, just a second. Okay. Oops, sorry. So pretty much those 2 years we went in there, and actually the first month gave everyone that we could notices. And we went in and just started working in groups of 5, 6, as tenants were vacating the property. We'd come in and remodel and just start, getting, increasing those rents, and it went pretty quick. And what we did to just keep things pretty simple, every unit, everything's exactly the same, right? So if we're remodeling 5 units, we're picking the exact same cabinets, flooring, paint. I mean, you keep everything simple and you just move it right along. And so what we did was by year 2, we were done with maybe 50% of the improvements there. And we were able to refinance. By year 2, the property was already appraised at a little over $1.5 million. And we were able to pretty much get all of our money back and have zero money invested in it as of today. And it's worth $2.8 million. Okay. This right here is a great example of a value add multifamily. Now I know, they're not easy to come by. I'm sure if you all are on this call and have any interest in multifamily, or just even if you're looking for a single family to rehab and flip, they're not easy. You really have to have some good connections or talk to a lot of people. Anyway, this right here is 24 units. This is the one side of the one building with the 24 units, 1 bedroom, 1 bath. And then we have 10 units, 2 bedrooms, 1.5 bath. And these are townhome style, so they have a small little backyard in the back. So let me go back for a second here, and let me just stop sharing here for a second. So before we continue, I kind of want to get an idea from those that are on this call today, who is currently involved in multifamily. You guys can maybe share or how many doors you have. Are you looking to buy? What areas? Just kind of shoot for a little so that we can kind of get an idea where we're at today with those on the call.
I'll get it started.
Great, thank you, Don.
I'm actually just, I started investing about 25, 30 years ago, and I'm about to sell a duplex that I have, and I'm interested in kind of refreshing my skills with a 1031 exchange. I'm going to try to buy a duplex in a different state. I'm moving from, I've already moved from North Carolina down to Florida, and the affordable housing market in Florida, they say is in trouble right now. There's a scarcity of affordable housing. So I'm going to sell a duplex in North Carolina and buy something down here through a 1031. And that's what I'm trying to refresh my skills on.
Okay. Well, last week I actually had my my call on 1031 exchange. So I'll probably do that again. We're not going to go into the 1031 exchange like today, but if you have a specific question regarding the 1031 exchange that I can answer, shoot, because I could definitely help. I'm actually going through it myself right now, and have been doing a lot of just investigations and just talking to a lot of people about it.
Well, thank you.
Mm-hmm. So, well, congrats on that, Don, because that's great. And I know that Chris, you're in Florida, correct?
Yes, I'm in Jacksonville, Florida.
Jacksonville, Florida. Okay, perfect. So let me, any other questions or anybody else? Let me look at the chat here. So Margaret, you're a commercial appraiser realtor and have clients looking for investments. Fantastic. Are your clients looking to join syndications? Are they looking to just purchase on their own? What, you on here? I think we might have lost her. Okay. So let me, I have a guest speaker today that I would like to present to everyone, and that is Chris Genzig. And just a little background, I'll let him share his bio and just his, what he has done. But he was head of operations for Toro Real Estate Partners. They owned about 4,000 units, and which were probably worth about 300 million. and 1,000 of those units were in Florida. And in 2020, he started his own company, which is JAG Communities and JAG Capital Partners. And they own 60 units, which are worth $6 million, and have a 10-year plan and just a goal to scale to 500 million. So welcome, Chris. I would love for you to share with everyone your story, what you've done and where you're at today, and kind of, what your plans are moving forward.
Yes, I mean, you touched on it a little bit. So I'm from New York originally. I'm in Florida now. I moved here a little over a year ago when I started my own company. But I worked for Toro for 4.5 years. I was there when we acquired about, like you said, 4,000 units, roughly 300 million in acquisition. I don't know, probably worth over 400 million. Once our value add and improvements were done and sold and stuff like that. So we bought 23 properties while I was there. We went full cycle on 7. So put them under contract, raised money, closed, managed them, and then, sold them off and, gave profits to investors. I think we averaged like a 25% IRR while I was there, with like an average 3-year hold time or something. And kind of when COVID hit and stuff, just decided I was going to start looking for just my own deal on the side, and found this great property down here in Jacksonville that I really loved. And while I was doing that, decided it was a good time to go off on my own, move down to Florida and build out a vertically integrated company. So at Toro, we would outsource property management, construction management, all that stuff. So I wanted to have that all in-house, have greater control and a better understanding of a lot of the stuff that goes into it. So moved down Thanksgiving weekend of 2020, took over all the stuff for that 16-unit deal. And we were spending probably about, we'll probably spend about $35,000 a unit between interior and exterior, completely overhauling that property. So all new plumbing, expanded pool deck with pavers, rebuilt the laundry room. We're going to do a grill area with a pergola, painted the exterior, replaced a bunch of the ACs, completely gut renovated the inside of all the units, brand new fencing, some new sidewalks, some new exterior staircases. So we did a lot of lifting on that one. We closed on our second deal, which is a 24-unit deal around the corner from that. Similar story, but not as intense, just gutting the interiors. We have our third deal we're about to close next week, which is another 20-unit deal. And then we got a couple other deals in the pipeline, a couple developments, which we're getting into now, and, some more existing, value add operational type stuff that we're doing. I've got 2 employees that work for me right now, a property manager and a maintenance supervisor. Currently interviewing for our third hire, which is a project manager. So if anybody knows anybody in the Jacksonville area that has those credentials and is looking for a job, definitely let me know. And like you said, our goal and our plan is to scale to 500 million in management in 10 years. And that's 500 million owned. So we'll probably acquire upwards of like 640 million, sell off properties as we go. But our plan is to find deals where, like you were talking about, we want to improve the NOI because that's how you create value. And that can be through, doing physical work to the property. That can be through operational inefficiencies. That can be through jaded ownership. That can be through, different types of, issues at the property. It could be just through buying in the right location. There's several different ways that you can increase value in a property and like force that appreciation, not just, the property goes up over time, cap rates come down, rents go up just on their own, which is nice. There's ways you can kind of come in and actually improve the operations, increase that NOI, and therefore improve the value without having to worry about, does this area actually improve or not improve?
So can you elaborate a little bit more? Like, give us some examples of what that would be, like how you can improve operational wise, and not so much, right? Like going in there and having to rehab the place. Like give people an idea.
The first one is a lot of, for me, my old company, we would target 150 to 500 unit properties. And those are all more sophisticated, advanced groups. You don't really have your mom and pop owners. the reason I target 10 to 80 unit deals is it's significantly easier to find people that have owned properties for so long. It doesn't owe them anything anymore. So they don't really have nearly as much incentive to continue to push rents. So let's say a unit becomes vacant and it could rent for $900. They renew it at $850, or they lease it for $875. And yeah, $25 isn't that big of a deal, but they get a better tenant in, or they lease it up quicker. But you kind of multiply that and compound it over 5, 10, 15 years, you end up having $150, $200, $300 deltas between what those units would actually go for today without really having to do a lot of work. And you just have to spend the time, energy, and effort to go in there, raise rents, bring units to market, lease them out, spend a little bit more time, maybe a little bit more polished marketing, better photos, understand which sites are the better sites over others. Like there's a lot of people that still just put picket signs out with a phone number and they don't have an online presence at all. So just by throwing it up on Zillow or apartments.com, you're going to be able to charge a higher rent because of the traffic you're going to get on top of throwing the sign out on front. So you find a lot of long-term owners, jaded owners, less sophisticated people, where if you can just understand what's going on in today's market, take advantage of some very basic technology. Like I'm looking at a deal where the property manager is 92 years old and he doesn't own a cell phone.
Wow.
So, he literally, would just rent with a sign. So, it sounds crazy, but those things do exist. So, sometimes it's as simple as that. And I'm not talking about like doing Facebook advertisements and like Google ads. I'm talking about literally just listing it for free on Zumper or putting it on Facebook Marketplace, which is a really great site for leasing. And it's just understanding that, Craigslist was great 4 years ago, and now Facebook Marketplace is kind of the new Craigslist. So if you can just stay on top of those things, ask around, you can do a lot better. A lot of times they have active contracts for their property that when you buy, you don't have to inherit. That can be higher than average. So, like there's different levels of pest control contracts, and we tend to choose the cheaper version because we do preventative maintenance. Our team will go in every quarter and look at the property, and we stay on top of that stuff. So we can be a little bit more reactive because we ourselves are proactive. Whereas you could get a pest control that is more encompassing and pay for it more, but they're the ones that are going to be proactive. So I save money by having my team just stop in. And we also do other stuff while we're there, right? We check on fire extinguishers. We change out AC filters. We make sure that, anybody who doesn't have pets all of a sudden doesn't magically have a pet and we don't know about it, because that costs money. So, we're tackling a couple different things while we're doing it. So, we actually save a little bit of money there. A lot of times, if you have multiple properties, you can negotiate better landscaping contracts. So a lot of times the contracts in place, you can, save a little bit of money on, do a little bit better. But, a lot of times it's, that the improvements you're going to make to the property, or, willing to bring rents up to market and spend a little bit more effort for the next year or two leasing versus just keeping rents lower, renewing your current tenants, having less turnover, which there's nothing wrong with. And that's, our plan. Once we kind of get in there, add our value and refinance, I would rather the property stay full. I'll lose a couple percentage points on rent to keep it full and do less work because I've done my refinance. I've pulled out money, and yeah, maybe if the market rent goes up 5%, I only go up 2% or 3%. But net cash flow is better the less you turn over.
Right. And how are you coming across these multifamily deals?
There's a lot of different strategies. So by all means, mine's not the best, but I'm 100% network referral based. I meet people every single day. I have a very tight criteria that I can deliver in one sentence or less. And people remember that. And then when that deal comes across, they know I'm there.
What is that? What is it?
10 to 80 units in C+ markets or better, with some sort of upside. And that may sound a little broad. And yeah, I get deals that don't fit, but because my criteria is a little bit more developed than that, but that sticks in them, right? Because 10 to 80 units, decent areas are better. You say that over and over and over enough to enough people, stuff
They'll
starts to
remember.
find you. So, you could say, some people will get super strategic and say like, well, I'll do anything, but I don't want flat roofs, right? Especially a lot of people in the north, because they don't want to deal with snow on flat roofs. Or in Florida, some people don't like it because of the rain, and potentially you get bellies, and then you get buildups of water, and then that leads to leaks. I personally don't care, but it's whatever. So you can get more strict or you can get more loose. So just by having a kind of a criteria, you can kind of do that.
Do you do any prospecting yourself, like actually calling owners?
Not really. I do it here and there.
Okay.
My philosophy is there's, in this space, there's a lot of owners and there's a lot of people that those owners already know. I would rather pay somebody to find a deal and have way more people. I can't compete against all the people I network with and know and who they know. Like even just commercial agents and brokers in general, right? Any agent is probably prospecting, the majority of their week. So even if it's 20 hours a week, I don't have 20 hours a week to prospect. I got a million other things I'm doing.
Right.
And then, there's how many agents and how many brokers. So, you kind of add all those up, and it's like, now you're talking about hundreds of hours a week that these people are calling and prospecting and stuff. I would rather just continue to know those people, continue to be, spend 5 minutes calling 20 people instead of, so call it 100 minutes every couple weeks. You're not going to call everybody every week. So every 2 weeks, every 3, every 4, I would rather just touch base, talk what they're going about. And a lot of times they've got some sort of deal, whether it's a perfect deal or not. I will always spend a little bit of time on it, even if it's just having a conversation, because 1, I stay up with the market and what's going on. 2, I touch base with them and just kind of see what they're working on, let them know what I'm working on. Sometimes things slightly change. And 3, when you talk about a deal, you're going to tell people what you like and what you don't like. And it can be totally up to you. They're going to start to get a better idea of how you look at a deal, right? And then sometimes there's the perfect deal for you that comes across their desk. You want to be the first call they make. And it may not be the only call they make, but you want to be the first one. Ideally, you want to be top 3 or 5.
Yeah. And that's something that I say on all my calls every week, is that really it's about networking and connecting with people. And you just never know. You never know who has that deal. And sometimes, and I know, and it's happened to me in the residential, and I have my list of investors or buyers, but you know what? Someone happened to call me at that moment, and maybe we're going through something on the transaction, and they just happened to call at the right time. And it's like, okay, fine. You know what? I actually have this deal. Here you go if you're interested. And things happen like that in this industry.
100%.
It's just, it happens. So really the moral of the story is connect with a lot of people in the, if it's multifamily that you're looking for, just connect with a lot of agents and just investors. Everybody.
Yeah. I just saw somebody asked about what's a C+ market. So
yes,
when we talk about, and this is, I hear it in all commercial real estate, but people will rank assets. So like the deal, and then they'll also rank the area. So basically you do it on a A through D scale. I've never really heard anybody do an F, but think about it kind of as letter grades. A+ is literally the best piece of dirt in the entire market. So, if you're in Manhattan, you're, Times Square or Wall Street or whatever it is, think about your own neighborhood. Where's literally the most expensive piece of real estate you could find, where everybody would love to live if you had an infinite amount of money. That's your A+. Sometimes people even say A++. And then you just work backwards, right? Your D, A+, A-, B, just kind of like letter grades. And then it really only goes down to D, and D is like your worst of your worst areas where, a lot of crime, really bad retail, more vacancies, more bad debt, and it's just kind of a reflection of that. And then what a lot of people will also do is they'll rank the actual building itself too, right? Because you could be in a really great area and you have an owner who's just let a building waste away for years and not taking care of it. You may be in an A location, but your building is a C or a B, right? And it's just kind of a reflection of like, you want to buy the worst piece of real estate in the best area because you can improve that building up to the same area it's in, and, now create a ton of value by doing that, assuming you buy it for the right price. So people will just kind of rank stuff out. So like C class is kind of like, like analyze, I don't know for sure, but the building you put up looked like a C area, C style building.
Yeah.
It's a little bit older, probably
C.
built in the 50s, 60s, 70s.
Yep.
It's more blue collar workforce housing. People that are living more paycheck to paycheck. Not that a lot of people in this country aren't, but that's kind of what you get. Your B class, you're more upper blue collar, lower white collar. Once you start getting into your B plus A minus stuff, you're starting to get into the renter by choice space. So people who just like myself, I rent, I choose to rent. You're starting to get into that space. And then when you get into your A plus, that's really your luxury, your new construction, or like your, really hot areas. Like there's a close to where I live, and I'm looking at a deal right now. It's a historical area. So all the buildings are built in 1920, 1930, 1950. But it's a really desirable area. So a lot of those buildings are really well taken care of. A lot of the finishes and fixtures are very high quality. So like that location, even though the buildings are old, I would call an A or an A plus. And the buildings can range anywhere from A plus to C, D, depending upon how well they're kept up. Like the building I'm looking at, the property literally behind it, I'm pretty sure is under like condemnment or something. So I'm trying to see what's going on with that, because it's just the siding's falling apart. There's broken windows and stuff. So it really depends. And it's crazy because the building I'm looking at is gorgeous. Like I don't really have to spend a nickel if I don't want to. But that's what happens sometimes.
And that's, that's a great explanation of pretty much A, B, C, and D properties. So they are rated by A, B, C's, and D's. And
yeah.
And like
and
you
what
said,
and what I would do to, take everything with a grain of salt. It's 100% subjective. If you're like, oh, this is a B property, and like, oh, that's, a B minus, just be like, okay, like it's not that big of a deal. So just, if anybody ever says anything, it's totally opinionated. It's totally subjective. There's no right answer. I mean, I would never call, unless I misread anything, the picture you showed, I would never call that an A property, but
not at all.
If you're off a little, if you're quote unquote off a little bit, nobody's going to do anything. And
Right. No, that was definitely a C property. I mean, it was a C class property. But D, I would say a D. Wait, let me refresh. So it's a C class for the area, but a D property, D for the property, because it needed a lot of work.
Yeah.
So what we were able to do was go in there and clean it up and fix it up and make it really a true C class property. And it was great. I mean, really, even like, I'll give you guys a quick example. During COVID, not one, maybe one tenant had some financial issues, but all other 33 paid throughout the entire COVID period. And you know what? That's just, it's just, they're hardworking people. They don't want to, they need a home, they need a place to live, and they don't want to be evicted. And they will pay for their housing. They're not just going to sit around and, and not pay for it, because they don't even want to risk the an eviction, right? Where are they going to go? There's definitely a shortage of housing in everywhere. I'm not going to say just in Texas, but there's definitely a shortage everywhere. We have a question here. It says, which one is a good investment if you're looking for passive income? Apartment or townhomes or single family? What do you think, Chris?
It's totally subjective. I mean, everything's got its pros and cons. I mean, what I advise people to do if you're trying to figure out what to do, look up a couple different asset classes. So I would classify townhomes as, unless you're buying, townhomes is a style of residential, right? It's, you got apartments, single family, and townhomes. You could buy a portfolio of single families, and, I would call it it's like operating multifamily. Right now, there's a really huge trend called BFR, build for rent, and they're building these single family subdivisions as one master community, but they're keeping all the homes as rentals. So it's basically multifamily, but they're detached units.
Oh, nice.
So, townhomes, apartments, whatever, it's just how you're going to operate them. Right. Multifamily is more traditional. Everything's in one spot, but like one of our properties is 6 quads that just happen to be right next to each other. I operate them as 24 units, even though they're on 6 different parcels. So, again, everything's a little subjective. But what I would say is, look at, for single family, look up a few different strategies and then come up with the pros and cons, right? So what's the pros and cons of flipping? What's the pros and cons of subject to? What's the pros and cons of wholesaling? What's the pros and cons of, BRRRR strategy, rentals? What's the pros and cons of turnkey, right? Like those are 5 different ways to do single family homes, and they've all got strong pros and strong cons, and some are great for some people and some are bad for others. The same thing for multifamily, right? You've got not only A, B, C locations, you've got A, B, C types of properties. You can buy vacant properties, you can buy turnkey properties, you can buy value add properties, you can do development multifamily. You can do 10 unit properties. You can do 200 unit properties. You can buy them yourself. You can syndicate them. You can, there's so many different strategies in every different asset class. Until you kind of know what the pros and cons are, you've got to work backwards. Right. And I think you touched on that. I was kind of doing some stuff while you were getting started. So I apologize for that. I've just got a million things going on. You got to figure out what you want, what your goals are, and work backwards. And that's one of the reasons I touch on my, 10-year vision. Like when I sat down and figured out what I wanted to do, I worked backwards. Like I use 500 million as like my thing because I think people can relate to it and it's a little bit catchy. But like my whole reason for doing this is the challenge and to create a company that I think people would want to work for. So like along with that 500 million is doing between, I think it's probably, I've changed it slightly. So probably about like, I'll go a little bit wider, 5 to 8 million in annual revenue, and employing anywhere from 60 to 100 people. And that 60 to 100 people is really the more important thing for me because, I'm investing in stuff. I'm going to make money. Like it's just going to happen. I'm not super concerned about that. Obviously I want a profitable company. But the desire to create a fun and nice working environment that I can be proud of is really one of the bigger driving factors. So for me, it was working backwards of like, okay, well, if this is the end goal, how do we get there? And then I have different metrics and different things that, and different marks that I'm trying to hit every year. So, my first year goal was to acquire $5 million worth of real estate. We purchased 3 million and went under contract on our, our third deal, which was 5.5 million. So I'm going to miss the 12-month. I'm going to be slightly delayed, but I'm going to be slightly over. So I'm okay with that. And then I've got a couple deals I'm working on. So I'm trying to acquire 8 million in our second year for a total of 13 million. I've got a development deal that I'm working on. If it gets rezoned like we think, it'll probably be about a $6.5 to $7.5 million deal. And then if this other deal I'm working on is about 1.8, that'll put us right as our mark, and we would be set for the year. So if we kind of continue that trend, we should be above that, which would be nice. So I would say you got to do the same thing, right? Where do you want to be in 3, 5, 10 years and work backwards and see what works best for you. And then recognize that in 5 years that might change.
Walk out of your life. Let them go.
That's me. Muted that. That's great. No, that's wonderful. And yeah, everyone has different goals, maybe, Chris wants 500 million and maybe, maybe you're looking for something different. So it also depends on your, I think a lot of stuff we have to take into consideration is also, where you're at in life, how old are you, what are you willing to risk, or how much of it? I mean, it's just so many, there's a lot of factors that have to be taken into consideration. And I think number one is, what are you willing to risk? Because no matter what, any one of these investments, there's always a risk. We hope that, it's always that you take an educated leap, at investing, but you also have to have that, okay, what if it goes the other way? So it really depends. It really depends. Chris, I wanted to ask a little bit more about this development project that you said you are working on in Jacksonville. Can you share a little bit more about that?
Yeah, sure. I mean, it's in the super early stages, but it's a parcel, literally 3 parcels down from our first property. I was chasing it for years. So it's one of the few, when you asked about looking at deals, it's one of the few ones I reached out directly. Eventually got in touch with the owner. They emailed me, told me they had tried to rezone it to do commercial, and then eventually said like, yeah, we're not interested in selling. So I was planning on, following up for, every once in a while for the next few months. And then I just got stupid lucky. I happened to be on Zillow getting ready to list a unit for our property, and I saw the land was for sale. So I called the agent and I was like, hey, what's going on? He's like, yeah, it's listed. I was like, what's the deal? What's the offering process? What's their expectations, stuff like that. And talked, and I was like, okay, I'll have you an offer in 2 hours. So just put in an offer at full price, got it locked up under contract. And I've just been going through the process. So it's already zoned for 8 units an acre. So we could build 20 units by right. It's 2.5 acre site, which is a pretty low density. So we will be building probably 20 townhomes if we don't get rezoning. But we are trying to get it rezoned for about like 36 townhomes if we can. We're trying not to shoot too high. The town would really like to see a small lot, single family type design. So they don't want us to come in and build like 50, 60 multifamily units. It probably would not get approved. So we're trying to shoot for somewhere in the middle where it's, we'll probably do like 2 townhomes per building. So they call it single family attached. So basically 2-story, 2 units per building. And we should be all in for roughly like 190 to 220 a unit, depending upon how many units we get and, the final finishes and final budget, and who knows what's happening over the next 6 to 12 months with materials and supplies. And we should build probably about like 1,300 square foot townhomes, 1-car garage, 3-bedroom, 2.5 baths. They'll probably rent for $1,800 to $2,000. And, that'll probably value the deal somewhere between $270 on the low end, $315 on the high end, which is obviously a really nice spread. And that's all per unit. So I think that's like $7 million all in, and like, 10 to 11 million in total value. And then, the plans to refinance, hold for another 4, 5, 6, 7 years, and then eventually, sell to, another investor.
Perfect. That's awesome. And do you currently have deals right now where you're looking to syndicate and looking for investors?
So we had a deal, like I said, that we're closing next week. So next Wednesday. So we raised about $800,000 for that. As of right now, no. I mean, I just offered on a deal. When we hang up, I'm going to be, we're in best and final. So it's between us and another group. It's that 12, it's that deal I was saying that, don't have to do a ton of work to, but, guys owned it for like 7 years, and it's just probably about like $200 to $300 below market rent with not really having to do a whole lot. Or we can add washer dryer connections and probably push rents $350 to $450, something in that range. So I'm hoping we'll win that, but nothing as of right now. But, we've got about 8 deals in the pipeline at various stages of underwriting and offering and reviewing and stuff like that. So a total of probably 8 deal. I don't know. I'd say probably about like $15 to $20 million worth of deals.
Nice. So if anyone is interested in finding out more about maybe what you're doing and maybe in the future investing with you, do you want to put your info on the chat and share it, or do you want?
Yeah, I'll just type my email in.
Okay.
If anybody, literally email me for any reason. I have no problem jumping on a phone, jumping on a Zoom call, whatever, just chat and shop, helping people out. If you're like, hey, I'm thinking about this, what do you think? I'll help you bandy about some thoughts and point you in the right direction. I'm never going to tell anybody what to do. And yeah, if anybody's like, hey, I've got some money, I want to invest in a deal. Happy to share it with you, but that's neither here nor there, right? That's not the the
Right.
final thing. But yeah, if anybody wants to do it,
Awesome.
happy to talk about it.
That'd be great. Any questions? Great opportunity. We've got a pro here who's actually doing multifamily and at a high volume. Any questions?
So syndication is basically you can do it for anything. It's basically pulling together funds, resources, or whatever. So like when I say $500 million worth of real estate, that would probably be about $300,000 to $350,000 in mortgages. I don't have $150 to $200 million to go out and buy those deals. So I raise money from investors. The typical term for that is just a syndication. Basically, so like the deal we just raised money for, we're buying it for like 2.35 million. We're going to be all into it for like I'm trying to think now. Around like 3 million-ish. And we've got a $2.3 million loan. So we raised about $800,000 from other investors. So we'll invest about 10% of the equity. This deal, we actually had more available. So we were more about like 25% of it. And then we raised the rest from other investors. And, basically we have, a couple fees that just, keep the lights on basically. And then there's a profit sharing structure. So basically as the deal performs better and gets increased returns, we take, more of the pie. But typically, our deals will refinance after 2 years, give people 30 to 80% of their original investment back at that time. Cash flow in those first couple of years could be 0, could be 5%, could be 8%, really depends on the deal. And then after that, typically it's double-digit cash flow and your remaining equity for another 2, 3, 5, 7 years. So, and it's a wide range because the more you give back, the higher percent return it is. So like if it was like we gave back 30%, the cash flow might be 10 or 12. You give back 60 or 70, your remaining cash flow might be like 35, 40%. So it really depends on how it is. Let's see. Is there a limit on how many investors can participate in? Typically, no. There is usually a minimum investment limit. Depends on the size of the raise. Ours is usually either 25,000 or 50,000. There's plenty of groups that will. Normally, no. So if you're ever looking at syndications or any offerings, the way we do it is through something called a Regulation D filing, and there's 2 different types. There's a 506B and a 506C. The 506B allows for non-accredited investors, up to 35 of those per offering, but you cannot publicly solicit. So like, let's say, even if I did have a deal, I could not tell you guys about it right now. So I just so happen to not have one, but I couldn't tell you about it right now unless we did the other type of filing because I can't advertise it publicly. But I can raise from non-accredited investors. If I did a 506C, you can only have accredited investors, but I could go on Instagram and Facebook and, take out a full page ad in the New York Times if I really wanted to, and letting everybody know that I have this deal that you can invest in. So you got to know what you are, and what type of offering it is. There's a few different ways, but an accredited investor is anybody that has a net worth of $1 million or more, not including their primary residence. Or you either make as a single person $200,000 a year or more for the past 2 years, and you plan on continuing to make it going forward. Or if you're joint filing, it would be 300,000. So previous 2 years and expected to do it the same going forward. So that's pretty much what that is. But yeah, typically there's not a limit besides that 35 non-accredited number, but usually it's not anything too crazy.
Another question there. Any advice for someone just starting off? I've heard velocity banking is a good way to start. I've heard using the equity on your current home that you reside in to use for investment. It's a lot. Okay, what are your thoughts?
Yeah, I mean, look, I think if you can borrow, if you're borrowing money to go put into something else, there's always a risk, right? If, especially in real estate, because real estate is not liquid. If you go and put it into stocks, for better or for worse, you can always sell it, get your money back inside of a week. Real estate does not sell that quickly unless you sell it for a massive discount. And then even still, it probably takes a few weeks. Maybe you find somebody that can close cash in a week, but then you're probably given a pretty big discount. So, there's nothing wrong with it. I would just make sure you don't over leverage too much. Make sure you have some sort of cash reserve for whichever property you're taking a HELOC out against or whatever, or, you have a job that can definitely support it. I mean, typically you're not getting a HELOC unless you're making enough income to support it anyway. They don't just give out money for free, even though they did at one point, basically in 2007. But it's a lot harder now. So just because someone's willing to lend you money does not mean it's a good idea. Right. And that's part of the problem that happened in 2007, 2008. Make sure you really understand what you're getting yourself into.
Correct.
Make sure you understand what the covenants are, which means like when they can call the loan. So basically, for what reasons can they call you up and say, hey, you're in breach of your loan or HELOC because of X, Y, and Z reason. You need to give us all our money back now or in 30 days, or you've got to fix how you're in breach of contract. So for one of our deals, we were going to do a line of credit as a primary loan. Great product. We were super excited about it. They just had all these negative covenants that was like, it was just crazy. It was like you'd be treading this fine line. And yeah, the chance that they call the loan is pretty low. But the last thing I want to do is get a call and they say, hey, you need to pay off your $1.6 million loan in 30 days, or we're taking you to foreclosure. So for me, there's more important things than getting the very best rate. So we chose not to go with that, but that's all a personal thing. Right. So, again, just goes back to like, what are your goals? What are your outcomes? And just make sure you really understand what you're getting yourselves into. Don't just listen to the person trying to sell you the product. Have an attorney review it for sure.
Yeah.
Let's see. So nothing wrong with it. Just know what you're getting yourselves into. Don't over leverage yourself. Or if you are, just understand the risk reward, right? There's nothing wrong with taking risks. Just understand how likely it is you can go to zero or go negative and, just be able to live with that. Thoughts on new construction 10 units versus existing, needing full gut rehab, how much land is needed? How much land is needed is totally depends on the location and the municipality. So like if you build downtown, you can build 50 stories on half an acre and you'll build 200 units. You're more out in the country, you're going to build a couple units an acre. So you got to know the town, the county, the zoning, and all that stuff. And then, so it could greatly vary. Great way to do it is if there's a deal that was just built recently, go on the county website, find out how many units were built, figure out how big the land was, make sure all the land was buildable. So like in Florida, we have wetlands. So you may have a 10-acre site, but only 5 is buildable. So they may have built 20 units an acre on what was buildable, but because 5 was unusable, it may look like 10 per acre. So just know that difference. If there's a building that was built recently, go see how big their land was, go see how much they built, and you can start to get a rough idea. Make sure it's just in the same zoning code. I ran into that problem once. We tried to tear down an old multifamily building and it was literally on the town line and we were on the wrong side of the line. So we had no shot. Luckily, we didn't put it under contract, but, make sure you're in the right area. Make sure you talk to people, just network with people that are doing it. They'll tell you, find people in your area, whatever you're looking at. But assuming you can do new construction, 10 units versus existing, it's just a different risk reward profile. And that's everything with investing, right? The more work that needs to be done, the more risky it is, and therefore the more reward you should get. So a gut rehab, even if you take it down to the studs, well, you've still got all the utilities, you still got the foundation, and you still got the studs, which may cost you $30,000, $40,000, $50,000 a unit, depending upon the size of it, or the location, or the cost of materials. So it's cheaper to rebuild when you already have existing stuff. Building brand new,
And
you
faster.
Yeah.
You don't have to go through the entitlement process and I mean, new
Exactly, yeah,
constructions are gonna have to go through. So if you buy land and it's not entitled, which means it's not approved and ready for you to build these 10 units, you have to wait that period.
Mhm.
Could be a year, could be a year and a half, maybe two, depending on, what the city decides. And if they approve it, that's when you can actually start construction. So then there's that period of 2 years where your money's really not doing it. You're not producing. I mean, you're gonna have, if you borrowed, right, you're gonna have to keep making payments until you're able to finalize the project.
Exactly. Yeah. So for our development deal, we still have 2 months left in our contract, and we just decided to go through the rezoning and entitlement process. We could build 20 units right now and basically have it entitled in like a month or two, I think. But for us, we decided to go through the rezoning process because there's the potential to add, to potentially double the amount of units, but increase the number of units by 50 to 80% is more likely, which adds a lot more upside, makes the deal a lot better. So which will probably take us, they're telling me 4 to 6 months. I'm assuming 6 to 8, just the way things go, if not even longer. So yeah, that's another good point too, right? You still have to get permits and approvals and different stuff if, depending upon how much you gut it. But it is quicker as well. So yeah, I mean, look, the safest thing is buying a turnkey product and you don't have to spend a nickel on it, right? Because, if something happens in the middle of doing a development, you don't have anything to fall back on that you can rent out and make some money and offset your expenses, right? Even if rent drops by 50%, right? At least you have some money coming in and it's not all out of pocket. If you've got a piece of land that you own, yeah, maybe you can rent the land for somebody to park some vehicles or something, but you don't have anything that you can really fall back on and rent and help you cover expenses. So that's why sometimes you'll hear the term covered land play. So there's a lot of big hedge funds right now that are buying 200, 300 unit manufactured or mobile home park communities in like these path of progress areas in like South Carolina, Atlanta, Georgia, all in the Rust Belt. And basically their idea is we'll buy something for a 5 cap. We'll make 5% for the next 5 years. And then we'll scrap it and develop it into apartments in 5 or 6 years from now, as more and more stuff kind of moves down that way and stuff gets more developed and it makes more sense to actually do it. So, you make 5% while you hold it, which isn't a whole lot for most people, but for a hedge fund with billions of dollars, it's pretty nice.
That's great. Yeah.
And then, in the future, you have an opportunity to develop it. So, like I was looking at one deal with a buddy where it was a triplex and a piece of land. And basically the rent from the triplex would cover the mortgage for both properties while it was being built. And then, we would be able to, build the townhome, the 2 units on the backside. So those are things you can look for too, to kind of bridge the gap. And then, God forbid something isn't as good as you thought it was as you develop, you've still got a cash flowing asset already built, and, it kind of helps blend the risk reward for the two.
Right. And that's kind of what, I mean, when I went in, my units were not producing just enough, but it was producing. So it didn't matter because I knew I was coming in to rehab the place, and I was actually going to get tenants out where I was going to not make any income, but it didn't matter. I still had another, 30. Let's say if I did 5, I still had 25 or 30 units that were giving me something, right? It's very different than developing. Developing, you will not have any cash flow until you're actually done with the construction. And it really, again, there are all great opportunities out there, but it just depends on what your goals are. Everybody's goals are different. Even, the financial risk that we can all take is different. Maybe I can risk $100,000, but maybe Chris can risk, $500,000. So you can't, you've got to just pull and learn and get yourself educated with all of this. And then just sit down and look at what your goals are and, what you want to do and what fits within your parameters so that you can make an educated decision in investing.
Mm-hmm. And the one thing to also look at, in development and stuff is, one of the reasons I'm even looking at development now is existing deals are starting to sell for very close to what it would cost me to build. So like we're roughly, like I said, in that 190 unit to 220 unit to build 1,300 square foot townhomes. There are 100 and 120 unit deals around the corner selling for 160 and 165 a door. And they're not even renovated. So the groups that are buying them are going to put in, ad fees and closing costs. They're going to be into that deal day one without doing anything to it. Call it $165,000, $170,000 a unit. They're probably going to spend $10,000 to $20,000 renovating the units in the apartment. So they're going to be all into these deals for, call it $185,000, maybe even more, who knows? And now they think they can make a profit. So they think they can then turn around and sell that building for probably $210,000, $225,000 a unit. I just told you guys, I think I can build for that price or less. Shit, I'd rather have a new construction deal for the same price I can buy a renovated existing deal. So I also looked at that, where if those deals around the corner were selling for $80,000, I'm going to buy the existing deal. Yeah. Or I'm not going to be as likely to get into development. Or if development was going to cost me $400,000 per unit, well, I'm going to say, how does that make sense? So those are the things, you kind of got to look at too, of like, if I can renovate if I can buy a property for $50,000, $80,000 a unit, gut it and renovate it for $50,000 a unit, be all into it for 100 to 130, but it cost me $220 to build brand new. That's a really good spread between the two. And you've got close to a brand new property. You've got basically a brand new property in an older shell. That's a really good spread. There's some value there, right? Somebody, yes, you're not going to pay what you would for new construction for that, but there's not a huge discount for a property like that. So, if I was looking at a new development versus what I just laid out, I would do the gut rehab all day, because there's less risk and a lot of upside, whereas it's a similar amount of upside to a new development, which has a lot more risk to it.
Awesome explanation. All right, we're actually over our time here. If there's any last minute questions, feel free to put them on the chat. And as I'm kind of saying my goodbyes here, we'll try to answer it. But Chris, thanks so much for your energy, for your knowledge. I mean, it's awesome. I myself love to hear this, and you know what? And I learn from everyone. I really learn. And so I appreciate you sharing with us all. I host this call every Wednesday. It's at 2 p.m. Pacific Standard Time, and we talk about multifamily. Like I mentioned earlier, I bring in guest speakers to share different things, that I'm not actually talking about. And then on other weeks, I actually go down the process of kind of, what I did to acquire the property. So join in. It's every week, 2 p.m. Pacific Standard Time. Chris, thank you so much. And if if there's anything I can do to help, I'm here. Feel free. You've got my email, and keep me posted with projects out in your area. I'm always interested.
Yeah, for sure. No, I appreciate you having me on. If anybody wants to reach out, you can email me, or, I'm all over on social media. If you just, search my name, LinkedIn, Instagram, whatever, feel free to DM me, PM me, whatever it is. And yeah, if I can help anybody in any way, let me know. And, Annabelle, we'll definitely talk some more and, see what's going on.
Absolutely. Thank you guys so much. Have an awesome week, and we'll see you next week. Take care. All righty.